Good morning, everyone. It is 6 a.m., half an hour before the market's going to open on Thursday, May 16th. Yesterday, we were talking about how it looked like a bull trap was setting up, and it didn't look like we could move a lot higher. And we said, hey, or we might hit 527, 528. It didn't seem like we hit 530. Well, we hit 530. We closed very close to 530. We closed at 529.78. So that just goes to show that everyone can be wrong. Everyone can be wrong. What is important, though, as a trader and investor is when you're wrong, you either lose very little money or you don't lose any money or you make a little bit of money. And when you're right, you make a lot of money. So what were the actions and what I said I was going to do? I said that I would take my gains and profits on my longs near the open. And if we did that, then we would have taken profits over here. And then on the shorts, if we hit 527, we would have closed out of our shorts and net this gap up in the longs represented about 3 times as much profit as the loss in the shorts. And if you did that, then you wouldn't have really lost any money. You should have, at the very least, broken even off of everything. And so you just would have missed out on these gains. So if we adopted that strategy, you wouldn't have lost money. You just simply would have lost out on some of this movement. Now, what does the world look like? A lot of people would get excited. Oh, all-time highs. Is it time to go all in on the market? For me, the answer is still no. It's going to start sounding like I'm a bear here. I'm not. I'm not bearish on this market. I'm just skeptical of a straight upward movement. And there's now a lot of signs in addition to the bull trap that was still sitting there from before. We just shot past it without triggering it, but that bull trap is still there. So why do I say that? So this morning, I actually spent a lot of time looking at the market. Usually when I jump in to these morning calls, I'm looking at it with fresh eyes, just like you guys are. And we're looking at everything and analyzing everything together. But this morning, because I was so wrong yesterday, I spent a lot of time looking at the market over maybe like an hour and a half looking at the market because I wanted to make sure and say, okay, well, was I just completely off the mark and I need to reevaluate everything? Or am I just slightly off on the timing? The good news, though, is either way, if you've listened to what I was saying over the past few days, you would have been neutral in your portfolio. And in most of my portfolios, I was completely flat, no positions at all. So we're going into this market with a clean slate. And so it's a great time as well to completely refresh our views on the market and see what is going on. So first thing that we're going to look at is we just hit all-time highs. Normally, when we hit all-time highs, what happens? Over here, we hit, let's see, this was an all-time high. We pulled back. Very short, very just one day, but we pulled back. All-time high, pull back. All-time high, pull back. All-time high, continued, 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 all-time high, pull back. All-time high, very baby pullback. All-time high went up for 2-3 days, pulled back. All-time high, even the next day, pull back next few days. All-time high, even the next day, or actually slightly down the next day, pull back. All-time high, pull back. All-time high went higher for a couple days, pulled back. All-time high, pull back. And now we're at our all-time high again. So are we noticing a pattern? All-time high, within a couple of days, we pull back. So markets rest. Sometimes they rest very briefly, just one day, but markets rest. When they hit new highs, they will rest. There was only a couple incidences here where we did not rest. We continued for 1 or 2 more days. There was one instance where we continued for, I think it was this one, 1, 2, 3, 4, 5, 6, so a week before we pulled back. So we hit an all-time high. Our expectation now should be that we pull back. It doesn't mean we change trend. It means that we pull back. We pause and we pull back. So if we pause and we pull back, that could trigger the bull trap that was in place over the last 2 days. So that's one reason why we still want to be wary. It's not all-time highs, let's go all in. It's all-time highs, let's wait for our opportunity. So let's take a look at other things that we should be looking at. So the one thing is that we always talk about is the dollar and the bonds. What are dollar and bonds telling us? Well, the last couple of days, they were telling us the opposite of what the S&P was telling us. The S&P went out over the last couple of days, but can the S&P continue to fly in the face of the bond market and the dollar, the currency market? The answer is no. An airplane can take off and fly. It can fly for 8 hours, 12 hours, and then it's going to come back down. It can temporarily overcome gravity, but it has to exhibit or exert a lot of energy in order to do it. And eventually it's got to come down and rest. It's got to come down and refuel. Same thing here. The S&P can fly in the face of bonds and the currency markets temporarily, maybe for a day or two, but it's got to come back and match, unless it so happens that the dollar and the bonds reverse direction and now agree with the S&P 500. But if they reverse direction, it's not because of the S&P 500. They just happen to do it. Like I said the other day, if I throw a drop of water in a swimming pool, it's not going to move the swimming pool. I'll have a small rippling effect for 1 or 2 feet, but it's not going to change the entire swimming pool. But the swimming pool, if the swimming pool moves, all the drops of water in the swimming pool move. So let's take a look at, and why would a swimming pool move? I don't know. Maybe there's an earthquake. Okay, so, not a perfect analogy. But if we look at DXY bounce up. That means a stronger dollar. Stronger dollar would imply lower asset values. It's not a huge movement upwards, but it would imply that stocks would pull back at least a tiny bit. So dollar is telling us that the S&P 500 should come down a little bit. How about the TLT? Bonds shot way up, gapped up yesterday on the CPI news, which if you look at everything that every single Fed speaker, including Kashkari, including Powell, including every single one who's spoken this thus far this week, and is probably going to continue to say today, we've got Barr, we've got Barkin, we've got Harker, we've got Mester, we've got Bostic, we've got Waller tomorrow, we've got Daly the day after. I don't know why so many people are speaking, but they are. And every single one of them is going to say what every single one of these guys have said, which is we need to wait and see if inflation is moving in the right direction. We're going to hold rates steady, and we prefer to hold rates steady rather than increase rates. So why, if we look at our probabilities, why did our probability of rate cut go up in June? In July, it's about the same. Oh, actually, no, it also went up. All right, so this is 31.4 and this is 31. So it also went up. In September, if I just look at these two numbers, okay, so this September looks like maybe slightly down, but I have a 70% chance of a rate hike in September, really, after all those Fed speakers spoke and PPI was hot, CPI was basically flat, it's just barely down. Okay. Terrible retail sales report. And then we've got November, which we're saying is over 80% of a rate cut, and then December, 92%. So the bond expectations, not the bond, interest rate expectations are way offline. And this TLT gap up on CPI was way offline. It wasn't a great report. It was better than previous, but it wasn't, oh my God, there's no more inflation. There was no reason for it to gap this high. If we got a green bar that smoothly moved upwards, that would be one thing. But we got this gap up all the way to basically the top of this channel. And we're going to open probably at the top of this channel. And guess what? We're at the top of the channel. So our expectation at the top of the channel should be what? This. There's no reason at the moment for us to say that we should break above the channel and run. So bonds are telling us we had a huge, it's like you're running a marathon and in the last mile you gassed up. You knew that the race was ending, and so you put every single ounce of energy you could to make it to the finish line in that last hour, so that you could, last mile, so that you could have an amazing time, or you could have the fastest time that you could possibly have. You're gassing out right here because you see the finish line. So if we gas out, then we should rest and come back down. And so bonds come back down, S&P should come back down. So from many angles so far, we are seeing that we should pause. The dollar, remember, is up, which means that anything priced in dollars should come down. What happens if I look at gold? Up and holding very nicely. Look, tiny bit down at the open today, looks like, but we're not pulling way back. And it's looking like this is a nice uptrend. So why is there demand for gold if stocks are so amazing? It's because people are afraid, or at least some institutions are afraid. They still have a safety on, which means that we should probably check on our sectors. How are our sectors doing? Are we seeing money going into defensive sectors, or are we seeing money go into speculative sectors? This is actually something I've not done this morning, so I don't know. Let's take a look. Let's discover it together. What happened yesterday? Where did all the money go yesterday? Silver, semiconductors, home builders, tech, real estate. So interest rate sensitive sectors, great. That is in line with what you would expect off of a strong movement, an expectation of lowered interest rates. But why silver? Why utilities? Why healthcare? Why gold? Why are these at the top? If I consider XLK, SMH as one sector, okay, and then so interest rate sensitive, interest rate sensitive, interest rate sensitive, interest rate sensitive, interest rate sensitive. So why healthcare? Why gold? Why silver? if I categorize all the interest rate sensitive ones together, then what I've got left at the top is silver, interest rate sensitive, healthcare, gold. Why? That doesn't make a lot of sense, right? So it makes sense. The interest rate sensitive ones make sense, but safety, safety, safety. Okay. So now we are seeing that maybe Wall Street hasn't completely bought in to the all-time highs. That is, let's take a look at let's look at futures. We haven't done that yet. Futures are down, not significantly, basically flat, but they're down a little bit. After hitting all-time highs, we shouldn't be surprised based on the very first thing we started this video out with. We shouldn't be surprised, but if we had bull fever and oh my gosh, great CPI report, which it wasn't, but it was a good CPI report. It wasn't great. All-time highs, big movement upwards in the S&P 500 yesterday. We should keep on running. We've taken out all the shorts. We should go. Answer is no, not according to futures. We're just flat. We're just staying where we were. So even futures traders are not, and the market, which is very reflective to market at this point, we're only 15 minutes away from open, the market hasn't bought into its own movement. Let's take a look at a couple other things before we get too close to the open. Now let's look at some momentum. If I look at my market momentum, these are every single stock trading above $2. So it's not the S&P 500, it's not the NASDAQ, it's every single stock trading above $2. Now let's take a look at our 20 MA. Okay, where are we right here? Can I draw a line? Tools. There we go. Line. I don't use the charting on bar chart that often, so sorry about that. Okay. Oh, that's hard to see. All right, that's the best we'll do. I'm not going to spend time messing around with it. But we're at a pretty high level here. You can see that it's not too often that we hit as high as we've hit right now, currently in the market. So in the last 20 years, we've hit it 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So about once per year on average, maybe slightly more. But it doesn't get much higher than this. Okay? So this isn't super convincing, but it is interesting to note that if we're not necessarily at the high, but we are kind of close to it. Let's take a look at individual markets or indices. I don't want to spend too much time on this, so I'll just look at the S&P 500. Okay, so let's look at the 20-day, 50-day, 100-day, 200. Okay, similar story that we just saw in the overall market, except it doesn't look like we saw 20 of these. It seems like less. 50-day, look at how high we are on the 50-day. Is this a line? Here we go. Over here, well, we're actually down here. Okay, so we're not that high on the 50. Okay, we'll look at where we are on the 100. And here we are on the 200. 200 is a lot more telling. 1, 2, 3, 4, 5, 6, 7, maybe 8 if we count this. And what happened? Well, on this one, look how far we dropped. over on each one, it either went a little bit higher, and then over the next few months we dropped, or we dropped immediately, significantly down. So what momentum is telling us is that it can't move that much higher before we need to rest. So everything we've been talking about is making a run and rest. We run or we move, we rest, and then we test, and then we make another run. So right now it is looking like we should be entering a period where we rest and then test. So that's what momentum is telling us. And then if we go over here and we look at one of our favorite indicators, 90-day highs, 454 out of 503 90-day highs. What do we say? We say when we hit the 400s, almost immediately, within 2 days, generally, we fall back down. It comes back down into 2 or 100 area. So I've got 454 making 90-day highs. I've got 23 making 90-day lows. That's an extreme disparity. And then I've only got, what is that, 477? So I've only got 23, maybe 26 stocks that are somewhere in between making a 90-day low or 90-day high. That means that's a really extreme. There's only 20 something stocks that are kind of in the middle. You're either making a high or you're making a low, and almost every single one is making a high. That is overextended. So within a couple of days, that should pull back. So everything that we've looked at so far, all these indicators that we're looking at are telling us this market is tired. And tired doesn't mean that it is necessarily going to stop, but is going to stop soon. And it doesn't mean that it's going to reverse direction, but it does mean that we're going to go sideways or pull back a little bit before that we can continue moving forward. So what does that mean? That means that as a portfolio manager or a manager of either my own money or other people's money, I'm going to wait for the best opportunity. Right now is not my best opportunity. The best opportunity is while we're resting, or actually even better, is once we see that test. So this rests, it might pull back a little bit, and then that is my highest probability for the highest profitability trades. So right now, if I want to enter a market, because I've been sitting out of it for a week or a week and a half, then I start thinking about deploying my capital and strategizing how and when best to utilize my money, that powder that I've kept dry or that I released over the last few days in order to make room for new positions. So that means I'm going to wait for a pullback, or if I really can't wait, I need to make sure that my portfolio maintains neutral. So if I go long, I do equivalent shorts. And that way I can take advantage of a pullback in my shorts. If my stocks that I pick truly are strong, they won't pull back that much. So what are the types of stocks that we're talking about? Oh, by the way, we should look at retail sales. So we had Walmart. Walmart super strong on earnings. Looks like they're going to gap way up. We had Under Armour, super weak, going to gap way down. We had John Deere, super weak. It's going to gap way down. So it looks like overall, Walmart is a giant. So, but obviously in the pre-market, we're flat. So balanced effect, but it is a reflection of that poor retail sales report that we had. That, and also Walmart tends to pick up the lower end people who are trying to save money. They stop shopping at Targets and other places, and they'll go to Walmart. So Walmart could be picking up. That could be why they're doing very well versus I haven't had time to look at anything. So that could be why they're picking up and they did very well. So just because Walmart is up doesn't mean retail is doing amazing. It could be people are price shopping now. It's like the other day we talked about Starbucks. Starbucks is losing profitability, or they're losing, sorry, not profit, revenue. They're losing customers. Customers are buying cheaper options at Starbucks or switching out of Starbucks. Same thing is happening at Dunkin' Donuts. So consumers are starting to pinch pennies, which is a recessionary sign, which is not great for this market. But that's not what we're talking about today. What we're talking about is that we hit these all-time highs. It's time for a rest. What we see often is that for at least for one day, we pull back pretty hard, or at least for a couple of days, we'll pull back to a important level like the EMA 8 or EMA 20. Right now, we have parabolically moved away from all our moving averages. So over the next couple of days, our expectation is that we'll come back at the very least to the EMA 8, if not the EMA 20, not necessarily the MA 50, but one of these two levels, which represents a pretty big downward move in the markets, at least right now, because we went parabolic. So we're going to wait before we go long. The overall direction is still a uptrend. We did break this downtrend. So this is now an uptrend, which means we don't want to go short, or at least super short in our portfolio. We want to stay long, but we want to do it at the best opportunity. And if I go long right now, I need to have a short to balance it out in case that we do pull back. I'm not hurt too badly, and I have a stock that is strong relative to the market, so that when the S&P pulls back, the stock that I'm in only pulls back a fraction of what the S&P did, but my shorts are working for me, and so net I still make a bunch of money. So we're less than 3 minutes away from the market open. I spent all this time basically to say, be careful. It's not a straight up trajectory. And the highest probability event is, hey, let's wait for a pullback before we go long. And we can go neutral right now. We can make new positions that are neutral, but let's not go long until we have a pullback. All right, hopefully we got the message, and it was a nice and thorough analysis for you guys. I will see you in the aftermarket.